Okay, thank you very much. So it is a pleasure to be here, and it's a treat to walk around this museum. I hope all of you appreciate how nice it is to be some of the first groups of people in here. So as I was walking around the exhibits, three things struck me. The first thing was just how exciting it is to be at MIT. I mean, what is going on at this school is just amazing. It's inspirational. You know, how many other schools, some people are figuring out how to get people into space, others are how to cure cancer, others are figuring out how you can track someone's typing on a keyboard to know if they're being afflicted by some type of disease. You know, those are just three of the things I saw. But it's really exciting to be here and be part of this community. But then the second thing that hit me walking around was when you see people doing those types of things, like sending people to space, I almost feel badly making you hear about economics as you're drinking, so apologies. But then the third thing that hit me on a more positive note was if you are inspired by all the innovation and exciting things going on out there and over here, one thing we have learned through time is that if you want to encourage innovation and entrepreneurship and R&D, to do that, you need a stable macro environment. You need price stability, you need strong protection of property rights and institutional strength, and you need dynamic capital markets that can provide funding for people who have great ideas. So even though economics is not as exciting as sending people to space, it's critically important. And a key part of that is price stability and understanding inflation, which I will talk about today. And I'm going to do an overview of some different research projects I've done in trying to understand inflation and the role of globalization, non-linearization, and how this all relates to financial stability, which I think is going to be the biggest risk going forward. So just to get you thinking, quick overview of how we got where we are today. We all know inflation today is a problem, but here's a quick overview to how we got there. So this is a graph. I'm going to show you a bunch of pictures today where I'm just going to look at a group of advanced economies. It's about 25 advanced economies. They're the big ones. They're the ones you all know. I picked them mainly because they have data, so I can have the same set of countries for everything I show you. And these are the countries that have done pretty well. They're the ones, the big countries that are pretty successful today. So I'm not going to focus on emerging markets, and then things get even more complicated. But this is, the black line shows average inflation in this group of advanced economies. Obviously, inflation far too high in the 1970s and then 1980s, and then inflation came down. And then we went through this era in the mid-1990s through near the end of the 2000s, where there was a sense that we figured out how to have price stability in advanced economies. We had people like Bob Lucas, Nobel Prize winner, giving the keynote speech at the American Economic Association, saying the business cycle has been tamed. We as economists have figured it out. So you young economists studying, you don't worry about things like recessions and booms and busts and inflation. We've got that nailed. Go study other things. And then we had Ben Bernanke giving a very famous talk on the Great Moderation, how partly due to the actions of central banks and economic management, we've sort of stabilized the ups and downs of the business cycle, and inflation again is contained. And it looked like that was true. So if you divide inflation into, say, too hot, above 2.5%, too low is below 1.5%, just right is the green bar, inflation was on average in a median in advanced economies just about right for this period. So you see where the confidence came from. But then the global financial crisis hit, and this is what happened after. Not so successful. For a period of the 2010s, a lot of it, inflation was too low. That's when you heard a lot of talk about deflation. Interest rates went negative to try to get prices back up. You heard about secular stagnation and some real soul searching of whether you'd ever get inflation back to a healthy level. And then COVID, and now we have the opposite problem. Inflation is up and up and up. We have inflation, average inflation, 10% in Europe, 11.1% in the UK. The US is almost 8%, doesn't seem so bad. Those are numbers we never thought we would see again, just completely out of line with any worst case scenarios. So what did we miss? What did we get wrong? And that's been a key theme of my research. So just to get you thinking along those lines, to understand what went wrong, you've got to go beyond medians and averages and really look at individual country experiences. So just to put this in context and get you thinking, is a question for each of you. How many years since 1980, so about 43 years, 1980 to 22, have the majority of the advanced economies, so these big sort of 27 big ones, gotten inflation about right? And I'm going to be an easy grader, not exactly 2%, but somewhere 1.5% to 2.5%. Let's define that as about right. Do you think that over 30 of the 40 plus years, they've gotten it about right? 21 to 30 years, about 25 to 50% of the time? But less than 25% of the time, 11 to 20 years? Just 5 to 10 years, or less than 5 years, less than 10% of the time? Okay, I'm not going to cold call, but let's raise hands. How many of you say A, 30 years, 3/4 of the time? Okay, you were looking at the last graph. Good, you passed that. How many say B, 21 to 30? Just 25 to 50% of the time. Okay, bold man in the back. How many say less, 11 to 20 years? Okay, how about 5 to 10? The pessimists in the group? And anyone for less than 5? Bold 2 people. You are right. Only 4 years out of the last 43 have just half of the advanced economies gotten inflation roughly in that range. Think about, that's actually pretty depressing. These are the successful countries, the models we hold up. These are the ones, the good independent central banks, famous central bankers. Only 4 out of 43 years have half of them been able to get it right. I'm not even talking, 3/4, half of them. The follow-up question then is what years? The 4 years that over half the countries have gotten it right, advanced economies have gotten it right, 1997, 2007, 2017. So I'm thinking 2027, right? If you follow the pattern. But then the pattern broke. 2018 was the other one. But that's it, 4 out of 43 years. So what I take from that is this isn't just an example of inflation being off recently or even having a few hard years. If you actually look at individual countries, not the average or the medians, most countries aren't getting inflation right most years. So it is very hard. Yes, the numbers are a little higher today, but it's hard in any given year, even some pretty stable years, for most countries to get it right. So why? What's gone on? Oh, and here's the distribution of that, of how many countries got it just right in each of the given years. Red again is the share of countries that got it too hot. Blue, inflation too low. Green, countries that got it just right. And you don't see a lot of green on that graph. But you also see some interesting patterns. There's some other years, it's not just recently, where you've had a lot of countries with inflation that was too high. But then often a year or two after that, inflation's too low in a lot of those countries. It's really hard. You get these big swings like we're going through today. And it's, what comes next is not always so clear. Okay, so why is it so hard? Why have we had such a hard time getting inflation right in the successful countries? And my research is focused on 2 issues. One is the role of globalization, and the second, nonlinearities. I'll focus more on globalization because nonlinearities is not fun to talk about when you have wine in your hand. But here's the issue with globalization. The issue is something we all know. The world has become a lot more globalized. Back especially in the 2000s, trade took off around the world. Capital flows increased dramatically around the world. Supply chains increased where companies make one part in one country, make other parts in other countries, assemble it in another country to sell to another country. So in financial flows, the financial markets have become much more integrated. So the world is just much more globalized. And as the world has become globalized, that means increasingly shocks in certain countries hit others and hit inflation in other countries much more than in the past. And this is a neat graph from one of my papers that captures this. So this looks at the principal component, basically the co-movement in different inflation measures of the same set of the 25 or so advanced economies. The red shows the shared global component of CPI inflation, the headline number that we tend to focus on. You see it was sort of bounced around in the 2000s, but then as globalization has really taken off, that red line has gone up and stayed high. And that's what we're experiencing today. The fact it's now about 80% means that about 80% of the movement in one country's inflation rate is shared by other advanced economies. So 80% of your movements in CPI headline inflation basically are happening globally in this set of advanced economies. So it's sort of no surprise that these global things happen. COVID happens, Russia-Ukraine happens, this global stuff happens. That moves inflation globally, and there's not much countries can individually do about that. And that's part of why it's so hard for central banks to get inflation in that range where they want. They're just being hit by these global shocks. And then I can break that down into how much of it is because of global supply chains, how much of it is from global oil prices, how much is it from movements in commodity prices other than oil, and how much of it is just from global demand, global slack in other regions that can drive that. And you can explain a lot of that. And that's what is happening today. These global shocks are hitting hard. Again, it's oil prices, it's global slack, it's hits to global supply chains, and that's driving that. But then the interesting part, on a more positive note, so you can't do much about CPI inflation. It's driven by this global stuff, and you don't have much control about it. But the more positive note is these other lines, the blue and the purple ones. These are core inflation, which is when you take out energy and food prices, and then wage inflation. And those, in global stuff matters for that. They are affected by global stuff, but not nearly so much. There's been a little uptick in the blue, the core one, but that's some of the global supply chain issues, which have been quite potent recently. But again, the good news is only about 40% of your wage inflation, your core inflation, is affected by global stuff. That means what you do in your own country in terms of raising or lowering interest rates, other central bank policies, what your fiscal policy is, that matters. And that is where inflation settles. And that's why when you do get these periods of high inflation in the past, like for example, after around 2008, where a lot of countries' inflation went too high, then afterwards it can come back. Some it's still too high, some it's too low, some it's just right. The actions domestic policymakers take are what's critical to get inflation back down to where you want it. The other reason why inflation is off and off so much is nonlinearities. And this is something, unfortunately, the models have not done a good job taking account of. When you get a little move in something, it often doesn't have as big effect. When you get a bigger move, the effects can be magnified more than 1 for 1 based on the size of the move. You see that now with oil prices, for example. When oil prices go up a little, people of airlines that are heavily reliant on oil will adjust their prices. But other companies that just use a little bit of oil don't need to adjust because of the spike in oil prices. But when you get big moves in oil prices, even if you just use a little bit, you're going to have to adjust your prices much more. So there's a lot of effects like that that we have not done a good job modeling, and that can also help explain why prices have moved up so much recently. Okay, so that's high inflation, and then that gets us to today. Inflation is high. We need to raise interest rates quite a bit to get inflation back down, avoid some of these nonlinearities, get to stable prices, get past the global shocks. What are the risks of that? And this has been a key focus of my research the last couple of years, is the risks to financial stability that are coming now as we raise interest rates. Let me begin again by backing up. To show you how unique the phase that we're going through in today is. This shows the number of central banks hiking interest rates in dark blue, cutting in light blue. We've hit a number of periods recently where bad things happen. A lot of countries lower their interest rates, and that's the light blue spikes. But on the far right, you see the dark blue spike. We have not had so many central banks raising interest rates so aggressively as we have had today. This is unprecedented, how quickly interest rates are going up. Borrowing costs are going up. Mortgage costs are going up. No one was expecting this to happen. I think back to just about a year and a half ago, is the Jackson Hole Conference. A lot of central banks got together. And about a year and a half ago, the prediction was the US wouldn't even raise interest rates once until 2023. Now interest rates are heading up to 4. Then we were talking about when they'd unwind their balance sheet and sell all the bonds they'd been holding. That was going to happen 2 to 3 years after the first rate hike. So we're talking about 2025, 2026. They've already started unwinding them, selling them at more than twice as fast as they did before. This is the fastest rate of tightening we have seen. And this is going to then, are we ready for it? Can we handle it? No one was expecting borrowing costs to go up this quickly. So what's next? So to motivate you, get you thinking about what's next, I am not predicting this is going to happen, but just want to sort of a little more background in terms of the risks going forward. Let's go back to 2008. 2008, global financial crisis. One major financial institution after another collapsed or needed to be bailed out. The global economy was on an edge. If you talk to policymakers then, there were some who did not know if they could stabilize things. We did. We got out of it, thank goodness. But one of the key lessons learned from this experience was the importance of macro prudential policies. So one of the key takeaways of that the experience in '08 was you don't just need decent monetary policy to have price stability, combined with microprudential policy, regulation of banks, which needed some improvement, but you needed a third key component, macroprudential policy. And what I mean by that is you need some institutions, some governance, some oversight of overall risks to financial stability of the system. You need to worry if one bank goes under, will that have spillover effects that bring down the rest of the system and other banks? If one big hedge fund starts selling something, and then those sales cause others to sell, and then prices collapse and markets collapse, and you end up in a doom loop, you have to put those pieces together. And no one is really thinking about that overall risks to the broader system and spillovers. So that's been the key focus since then. A lot of my research has been on what we're doing to address these macro financial risks. There's been a big movement. Most countries now have a macroprudential authority that looks at these types of macroprudential risks. This shows the increased use of macroprudential tightening regulatory measures to try to address risks around leverage, capital requirements, and these spillover risks and interaction risks in different institutions. But as that's happened, so that has happened. That's a very positive change since '08. There's now much more attention to these macroprudential risks. But a lot of that tension is on banks. So banks are better capitalized. They're less leveraged. They're better ready to withstand lots of risks to the broader financial system without spilling over and bringing down the system. But as you regulate banks more, it's harder for them to make money and do business the way they used to. So people are going to other places to get loans, to get financing. And we've seen this big shift in what's sometimes called shadow banks, in green here NBFIs, the non-bank financial institutions. Basically, a lot of more financial intermediation is moved away from banks to other types of institutions. And that's a mismatch. It's hedge funds, it's mutual funds, it's money market funds, it's pension funds, it's life insurance funds, it's LBOs, it's venture capital. Probably some of you in the room are part of the shadow system or the NBFIs. And it makes sense. You regulate the banks, more expensive to do business there, business goes somewhere else. Is that a concern? Initially, my take was, no, it's not a bad thing. Banks are safer, more solid. They're not going to melt down, bring the system down. So you've risk spread out on all different types of institutions with different risks, diversification. That sounds good. But where my research has gone recently is that there are some risks. I'll skip that. The big risk is as you get more financial intermediation and all these small, diverse players, they aren't as well able to handle big risk shocks when there's big shifts in pricing, big moves in financial markets, or big risk-off moves. So this is a graph from one paper where we look at portfolio investors, mutual funds, hedge funds, all sorts of investors, lots of great data around the world. And when you got COVID hit, what happened in countries that had tight macroprudential regulations in blue, you saw a big outflow of capital. People had to pull money out. Countries that hadn't tightened macroprudential regulation as much, there was more stability. You didn't see the big outflows to the same extent. And this is part of this bigger research agenda, which is starting to have me more worried right now, which suggests that as you tighten macroprudential regulations, more financial intermediation goes outside of banks. The system's just a lot more volatile. When you get these big movements, risk on, risk off, good news, bad news, there's just a lot more volatility and a lot bigger swings in pricing. Some of our estimates say it can magnify the impact of risk shocks on portfolio flows by 50%. So the numbers are big. So that leads me to the world we're in now, which is where my worries start. We have these tighter macroprudential regulations, a lot of benefits. We've got a safer banking system, a more resilient banking system. That's a good thing, without a doubt. It means that financial risks are more diversified across the financial system. Different institutions, different players behave differently. International capital flows are more resilient. International capital flows have held up pretty well the last few years. But the big risks are that now there's more and more financial intermediation in lots of different institutions, some run by people, not any of you, of course, but some run by people who don't fully understand the risks they're taking on. They aren't ready for the big moves. They're not as well hedged. They're not regulated also, so governments don't understand some of these risks. They don't understand how these different investors behave when different shocks happen. And we just saw an example of that in the UK in October, where bond yields spiked, and there were a number of these LDIs, these investors that were supposed to be hedges for pension funds, were not ready for the risks. They had to sell. That forced selling and froze up the whole treasury or gilt market in the UK. And I think for me, that was the wake-up call. That was a warning. As interest rates are going up now, we are in a very different world. Costs are going up. A lot of these financial institutions have a lot of risks we don't understand. So we are in a really tough situation. We have to fight inflation. We have to raise interest rates. But I think it's going to be a rocky year ahead. With that, Scott is now going to cheer you up and tell you about some good things to look forward to.